Good morning, everybody. High Mount Research Market Insights video for April 4th, 2023. Good morning, Willie Delwich here. I got a few things to talk about today. I want to update the weight of the evidence for April and then go through, I think, a couple of the key slides, a couple of the key charts as we think about the weight of the evidence and risks and opportunities for the month ahead. So we'll begin first by looking at where we were back in March. This is the weight of the evidence scales from March. We had all the macro things were on the risk side. We had financial liquidity, economic fundamentals, valuations. Those were all identified on the risk side. On the opportunity side, the market indicators, trends and momentum, breadth and sentiment. This is as of March. Fast forward now to this month, our new update. You see the scales have tilted a little bit. We took financial liquidity off the risk side, but we also took breadth and sentiment off of the opportunity side. So when we weigh the evidence, we've gone from kind of a zero neutral type score to -1, more of a cautious message from the weight of the evidence. Let's go through that and look at kind of what we're seeing as we look at the various aspects. We'll begin from a financial liquidity perspective. Here we're looking at BAA corporate bond yields down at the bottom. This is actually the change versus 26 weeks ago. So 6-week momentum in corporate bond yields spiked last year. And as we've stopped going higher, we haven't really broken down, but we've stopped going higher. And so now, for the first time since late 2021, on a 26-week basis, corporate bond yields are lower than they were 6 months ago. Why does this matter? Because when liquidity is improving, stocks tend to do well. The stats are up above. Red line, that's the S&P 500 since 2000, right through the middle there. Green line is what happens if you're only invested in the S&P 500 when yields are rising. The orange line when yields are falling. The numbers speak for themselves. All of the net gains over the past 20 years really goes back to 1965 even. All the net gains come when bond yields are lower than they were 26 weeks ago. So yes, we have liquidity headwinds from the Fed, but on a kind of on a marginal perspective, or at the margin, we're seeing some improvement in liquidity. So that helps support the case for moving it from a bearish influence, from a risk factor to more of a neutral factor. Look at the economy. This is real final sales to domestic purchasers, a fancy way of saying real domestic demand, year-over-year change in blue, quarter-over-quarter change in orange. For 2022, on a yearly basis, real final demand grew less than 1%. Anytime it's been this low in the past, we've been either going into or just coming out of a recession. The takeaway here is the economy is near stall speed. There's lots of areas we can look at where activity has flattened out over the last couple of years or isn't any higher than it was pre-COVID. So some economic headwinds to deal with for the market. From a valuation perspective, orange line, the S&P 500, blue line, that's the forward PE ratio for the S&P 500. So price now versus what expectations for earnings are over the coming year. You can see we had a valuation reset last year, but where the forward PE ratios have bounced off of their lows, never got below the long-term average. Now expanding a little bit, and what makes this particularly challenging is not only are stocks expensive relative to earnings expectations, but earnings expectations remain relatively high. Median S&P 500 earnings growth is expected to be close to 16% in the year ahead. So that's not, it's not that the market has factored in a slowdown in earnings, and that's why valuations are high. Stocks are expensive relative to elevated earnings expectations, also expensive relative to bonds. So that's a headwind. So sentiment, we took sentiment from bullish to neutral. A couple reasons for that. So we've seen in the weekly data less optimism, even some signs of pessimism, not excessive fear though. VIX remains relatively low, haven't gotten to those excessive pessimism readings that we saw last year. And we've talked about at this point in the cycle, after we saw those excessive pessimism lows of last year, we want to see increasing optimism. We're not seeing that, But at the same time, we do see positioning remains historically high. This is the AAII asset allocation survey. Exposure to equities remains above average, has as it has this entire cycle. We haven't had that positioning unwind. And my concern is, my expectation is that the longer we see sentiment displaying some signs of pessimism, or waning optimism, the more there's a risk that we see this broader reset from an asset allocation perspective. The best thing for bulls right now would be to see increasing optimism. We're not seeing that. If that changes, then we can update this going forward. But right now, we've seen waning optimism at a time when households have relatively high exposure to stocks. That seems to not be a favorable backdrop from a sentiment perspective. From a trend perspective, not seeing a lot of bull market behavior in the US. Updated that checklist multiple times, not really seeing those trends turn higher. On a relative basis, however, we can start to see new leadership, are starting to see new leadership in the rest of the world versus the US. Go back the past decade, we've had these extended runs of the US leading the way higher. Um, the rest of the world, only these brief interruptions of leadership. Now we're at 17 weeks in a row of the all country world ex US, the ACWI X index leading relative to the US. There was a time a few years ago that we had a slightly longer period of strength for the rest of the world in this kind of decade of US dominance. But if we go back further than that, we can see that international leadership used to be a thing. That's where we're seeing leadership now. We're starting to see uptrends emerge in Europe and in the UK. The EFA index, so this is like the rest of the world, uh, can be thought of as EM and EFA basically. There's a couple other things, but the EFA has started to turn higher from a trend perspective. So we're starting to see that rotation. Positioning for that is going to be, I think, a key element of success, not from a tactical perspective going forward, but from a dynamic strategic perspective as we think about the next quarters and next few years. So trends outside of the US stronger than trends in the US. And then we'll wrap up with breadth. We started the year seeing more new highs and new lows as March progressed, as Q1 progressed. That stopped. Our net new high advanced decline line turning lower, the long-term trend in the S&P 500 turning lower. If we're going to talk about not fighting the tape in this environment, that does not mean looking higher. It means at best neutral. Really need to see more new highs start to come into the market if what we saw over the kind of second half of Q1 was healthy consolidation that leads to resolution higher. But for now, breadth is back down to neutral. And so this is kind of the scorecard. You can see financial liquidity is neutral, sentiment's neutral, breadth is neutral, market trends and momentum remain bullish, fundamentals valuations remain bearish. So that's the weight of the evidence update as we go into April. If things change, then we'll change with them. We'll adapt as market conditions suggest that we should. But for now, the weight of the evidence arguing for a little bit more caution now than what we saw at the beginning of March and what we saw over the most of the first quarter. So that's a Market Insights video for today. Have a great week, everyone, and I'll talk to you again soon.